Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Friday, February 20th, 2026. It is 10:32, now 10:33 a.m. Eastern Time, so I'm starting the video, and we're going to talk quickly about the markets. The SCOTUS decision is out. Supreme Court of the United States has ruled against Trump, saying his tariffs were invalid. I'll talk a little bit on that, not too much. We're going to talk charts, and that actually segues into this question. I had an early doctor's appointment. I got back to my desk shortly after the markets opened today, but and then came a couple questions. Let's see. Somebody. This is just yesterday's replies. These. And then I caught up on this one today. These were new ones. Somebody asked about AVD. If you're interested, that's one of the ag input stocks. And I think, yeah, it still looks good. My replies there along with the charts. And then this one, good question. Looking like the shipping stocks are going parabolic. Sorry, I kind of sitting down at my desk and catching up. I answered this second part of the question. I'll look at that. I've been watching the shippers. I have a watch list. Here, why don't we do it now since the question was asked and I didn't reply there. Let me float this window. I use multiple monitors. I have to do, how do I get this over here? Float new window right here. Okay, here's one. I have 2 or 3 different watch lists for shippers. And so we'll go over these real quick. You can see my list right here. And yeah, let's take a look at the charts. I'm going to move it out of the way just so I can show you the charts. TNK, that's one of the biggest ones. Yeah, certainly going up. I don't have a strong opinion on this chart right here. What you like to look for at the end of a run or divergences. That one had a big divergent high, but remember, divergences are not a sell signal, they're condition. And then finally, sell signals come on things like trendline break. So you just nice uptrend line right there. You can see this stock, like many, not all. That's the thing. Not all stocks behave well off their 200s, but a lot of them do. In a bull trend, you buy pullbacks to the 200. It works great. And then when the 200s are taken, the trend is over. You also had a sell signal there, or likely over. I'm sorry, that's a sell signal. You also had a break of the trend line, the primary uptrend line, then a back test, a rejection, and that gave it a bear market. From that point, if you shorted the break of the trend line or the 200s, you made about 46, almost 50%. Not bad. And look where it ended. Nice divergent low. So this is, again, it's not the be-all, end-all, but as you guys know, a big part of my trading style. It just tends to work better than anything out there, especially fundamental analysis. I'm going to get to that one second. So on this, you have almost a divergent high. It's what I call an ADH because you have about ever so slightly. If the PPO turns down now, it will be a divergent high. It can't go up much more. The sell signal would come on a break of this minor trend line. And then, of course, again, these 200s. So there's a lot of hot air or thin air, I should say, between where prices are now in the 200s. That's just TNK, one of the biggest ones. Let me just sort these by market cap. I can do that. Here's my watch list. If I sort by capitalization, we're going to look at the biggest ones. That kind of gives you an idea. So yeah, they're strong. I wouldn't chase them here. I wouldn't short them, at least not yet. No sell signals, KEX. This one's starting nice divergent high there. Bottom line, I think that ship has sailed, no pun intended, on the shipping sector. So it's kind of my views. Again, draw these uptrend lines. See, this one gets sloppy. This one's gone through the 200s a few times. It doesn't behave, quote unquote, as well. When I say behave well, it means if you hit that support level and bounce and you have distinct reactions. MATX, it looked like I already had a bullish falling wedge on this one from before. Broke out. Nice run. Missed that. Actually, I was watching him back. I don't know. Maybe I did throw. Yeah, I think I might have thrown. We might even have a shipper on one of the long trade ideas right now. But that one's at resistance, previous high. STNG. Yeah, see, they're all starting to put in if they reverse soon. And again, that divergence is a condition, not a sell signal. But what would be a sell signal? Nice. A lot of these have these nice clean up trend lines, so you want to look for that. So bottom line is I wouldn't chase them here, and I would certainly wait for the sell signal. And then if you do it the way I'm doing it, and you have you look at the list, there's a lot of shippers, as you can see. And again, I have different watch lists. This one particular list has 23 different shipping stocks in there, but I'm going over the largest ones. And those are the ones that, are going to make the difference. Most likely lead the rest of the sector down. And keep in mind also that there's variation between the shippers that I have on my watch list. In other words, some of them transport LNG, some of them transport cargo. Some of these might even be I might even have some ports in here. I don't know. Again, you have to look at them individually. So that's it. A lot of them look ready to pop, but I don't see any on sell signals, at least not here as I'm going through the big names in order of market cap. Certainly strong, but very, very overbought. And also remember, as I've covered in many videos, when you get too far, the 200-day moving averages are kind of not an anchor, just something that when you get too far away from on either direction, in a bear market, you get really far away from them, you're going to have that snap back and mean reversion. And so again, at the very least, you can see the stock is the most overbought it's been in years. So that's it. You can either short for a quick pullback trade when these short-term uptrend lines are broken, or if you think that's it in the sector, I'd have to review it a little more. When you get your sell signal, then set a stop above the recent highs or a little bit up there, maybe allow for a back test and let it run. Pullback targets on this one, I'd say right here, I can see you have price support there at about 1385, and then the 200-day moving averages, which buyers in a bull market buy pullbacks too, right? Especially when you're trending. When you see a stock that's gone through the 200s, I always say this as well. Don't use the 200s or any moving averages. Don't put too heavy a weighting into them when a stock is in a trading range. Because when you're in trading ranges, you're gyrating, you're going to go back up and through them. It's when a stock starts trending, whether it's a bull trend, an uptrend, or a downtrend, that's when they behave well. And buyers buy pullbacks to the 200s, or in a bear market, we haven't seen one in a while in these, they'll sell it. Okay, let's move on to what I wanted to cover. Start out, as I often do, with the equity markets. Let me go back to that question. Okay, so there it is. So there's the shipping stocks. Also, how do you plan to trade the Supreme Court decision on tariffs? Odds are they said some tariffs are illegal and the administration stops them and immediately replaces them with other tariffs. I'm thinking a big relief rally followed by a drop driven by every business that is wasting time and money paying these taxes. Look, I can't argue that. We can sit here all day and I'll come up, and I'm sure you ask 10 different people, you're going to get 10 different scenarios of what could happen. So here's my reply. And I welcome these type of questions, guys. I really do. But here's how I would reply to that, or I did. I trade the charts, not the news. As all known and likely, again, it wasn't a known variable how this decision would go, but the likely, it went the way it was likely to go from what I've heard. So all known and likely variables are usually, again, that's not always, but usually mostly or fully priced into the charts. Even though the Supreme Court decision could have gone either way, it was just released right as I sat down. I got this question, sat down. I had a doctor's appointment this early in the morning. Then I'm back, sat down at my desk, and then CNBC said they broke it. The decision was out. But here's the thing. I don't trade on headlines unless, I'm not anti-news, and I'm completely recognize that, headlines, especially headlines when something is completely out of the blue or unexpected, or comes out and things go, let's say everything was supposed to go one way and then there's a news event, things go the other. So I don't trade off headlines unless those headlines trigger buy or sell signals, or they undo previous signals in the charts. So no change in the charts. I'm going to show you something in the NASDAQ that I'm looking at, but bigger picture, no change in the charts of the broad market. or any key stocks or sector at this time. So therefore, there's no change in my outlook. But let's see how today ends. All right, now let's dive into the charts and I'll show you. Okay, here's QQQ. I keep pulling this box. This is my trading range, multi-month trading range. Oh, and on that, by the way, just this whole thing here, when I say it often, the news, again, I'm not dismissive of there's valuable news, and you're just I'm always reading headlines and kind of getting the flows and the trend where things are going, certain developments. So there's certainly value in reading the news, again, but when you try to act on it, including earnings and earnings releases and other headlines, again, most of the time it's priced in from those in the know. The market is very efficient. There's a lot of talks out there. As I told you, the insider trading always has been and always will be rampant, both legal and illegal. And again, those things usually are priced in, and that's why so many times you've seen it's the whole buy the rumor, sell the news kind of thing. Today, looking at my inbox, Yahoo Finance, 6:05 p.m. The headline to that, the morning brief: stock picking is back. Let me repeat that. Stock picking is back. See, that's why I call this site right side of the chart. How many months and quarters now have I been saying? Before this trading range even became really a clear trading range, it was a stock picker's market. We were throwing out plenty of long and short trade ideas, all kinds of sectors, industries. And again, I don't have the official stats. Go back. They're all the trades are posted on the site. I'd say we're probably running about 80% success rate, at least on trades hitting price targets versus those being stopped out. We've had a handful of trades stopped out in the last month or two. And we've had dozens hit price targets, many of those well into the double digits, even high double digits, blowing away the market, which gone nowhere. So again, that's old news. Now, the thing is, by the time you start getting the headlines and everyone realizes the stock picker's market, that's often about the time that stops. It stops being so conducive. Again, it's been an extremely profitable market. If you're only trading the indexes, you're going nowhere. You're spinning your wheels unless you're a very nimble and active day trader, right? All right, so just wanted to point that out. So now, from a technical perspective, so bigger picture, again, I speak on multiple time frames. We're still very, very much in the trading range. In fact, QQQ remains on the bottom half. There's my delineation line about the 614 level, the midpoint line. So we're still on the bottom half, right? And with the 200s just below, and then this target here. So at this point in time, there's still a higher risk. Remember, it's Friday. The day is young. I'd like to see how the day ends. My guess is whatever rally we have midday, we're probably going to see profit taken by the end of the day. You've got, Trump banging the war drums again in the Middle East. The market seems to be shrugging it off, just like they didn't care too much about Venezuela. Venezuela, kind of, let's pick my words right. More of a, I don't want to call it banana republic. It is obviously one of the largest countries in South America, developed country. My wife was born in Venezuela, so I'm not trying to put it down in any way, shape, or form. But Iran and the whole Middle East thing over there, it's has much more of a potential to become a hot zone, if depending on what happens. Okay, I think we can all agree on that. So what I'm getting at, I don't think risk is being appropriately priced into this market for this weekend, for going home over the weekend. Plus, what I've listened to wasn't long. Had CNBC on for a couple minutes, and they're hashing over the takeaway from the SCOTUS ruling is that one dissenter, Kavanaugh dissented, but again, the rest of them, the lot, said, okay, the tariffs, you can't, for the reasons he did it, can't do those tariffs. They have to be unwound now. Yes, there's all these other not loopholes, but provisions that. And I'm sure the White House has plan B and C lined up. Well, they'll try to reenact some other tariffs. But what I'm hearing now, at least again at first glance, is they have literally billions of dollars of tariffs that have been paid that now have to be reimbursed, and that the Treasury just can't even possibly do it. So where I'm going to go, I'm going to move after. I'm going to go over the stock market charts, and we're going to look at Treasury bonds and then business development companies, and really the financial markets, financial sector. I think that's where the risk lies. So, risks are always somewhat bilateral. If you're short, in other words, bilateral risk, if you're short, the risk of a big blow up. But look, the NASDAQ isn't anywhere close to breaking out, has plenty of overhead resistance. So again, I don't think anything's possible. We could have a huge gap up on Monday. I think the odds favor a big gap down versus a gap up. Again, it may be wrong. Let's see where we finish. Let's see where the charts finish today. We do have a breakout on that 60-minute chart. I gave you the downtrend line. We'll see if it sticks. Again, I think it's probably going to get faded today is my guess. So, all right. Before I go to the shorter term charts, there's SPY. SPY also still in its trading range, still remaining above the midpoint, so in the upper half of the range. And SPY, has a greater chance of breaking out to new highs before it does breaking out below to the bottom of the trading range. But again, it's still been forever and a day since it's checked its 200-day moving averages. I've gone over that in the past. Every so often, even in the most strongest of bull markets, the S&P 500 is going to come in and check its 200-day moving average from time to time, and it's pretty much overdue now. So I maintain that any new high, as I've been saying, anytime soon will just be a pattern of what we've been getting, a marginal new and still divergent high followed by a failure of that breakout to new highs. So I see, again, to quantify it, I think the risk reward remains to the downside. I see minimal upside. Again, in the very near term, in the, say, next couple weeks, right? Or let's just talk next week, because today's Friday. You're going to have to decide how to go home. And I think that's where that lies. Other trend indicators, like we're above the the PPO line. This trend indicator is bullish and all that. So it's what I've been saying for months now. And when I want to talk about the broad market, it's blah. It's in a trading range. It's trying to squeeze water from a rock, blood from a stone. You can actively trade, day trade. There's certainly plenty of opportunities there. I've shared a few recently, but that's it. So let's drop down to the shorter term charts, 60-minute charts. This is the S&P 500. Just in the bigger range, which is right here. This is what I boxed in on the daily chart. You do have swing trading ops. Look for the divergent highs, look for the divergent lows, go long, divergent high, drop, divergent high, drop, divergent high, drop, divergent high, drop. This was a divergent low. It was actually two divergent lows, or it's an extension of the same divergence. You can see these are the divergence lines down here on the indicators. Pop, divergent high, drop, divergent low, pop. Okay, guys, this is it. This is like an irregular EKG. And again, if you're an active trader, I don't have to tell you this. There's plenty of profits to be extracted, but you got to be in and out. These are trades lasting just days, sometimes, and I've given you even single day trades recently. QQQ took out. Here's that last update I gave you. I told you we had a bullish falling wedge pattern. And the last time we hit there, I predicted a pullback, short trade, that was that 650-ish support. We hit that, and now we have broken out. So on the shorter term time frames, this is a now, and that hadn't even happened when I made that reply. But this is the only significant technical development I see, and it's clear. And it's an impulsive breakout. You got the PPO, the PPO is still above my my delineation line, trend delineation, which is the negative 0.49. We'll call it negative 0.5, 0.05, 0.5. That, and I'm talking about the signal line there. I covered this just recently, I think as recent as yesterday. So, when we hit it and we bounced, and so that's keeping, that trend indicator bullish for now. And we'll see where this goes. I may have to tweak some of these resistance levels. I think I gave you a bounce target zone the other day on QQQ on the futures. I had it hand drawn in. Let me pull the futures. There's that 15-minute chart I gave you, the day trading op. That was the stop on it. We shorted it there, I think, and that was the target. Closed that Friday there, and then it hit on the Sunday evening trading session, or the Monday when the markets were closed. So that was, profitable, was like 1.5. But then this is that downtrend line. Here, let me drop it down to the 60 and you'll see. So there is a breakout there. And so unless that break, here it is. This is my 60-minute chart, NQ futures. And so that gives you, this was your most recent divergent low. Just like that was the previous divergent low. And just like that was the previous divergent high. Again, it's been like I said, it's been a stock picker's market as far as swing trading for multi-week, multi-month positions, like a lot of the swing trades we have. And it's been an active trader's market. If this is your wheelhouse, just banging the NQs or the QQQ off these support and resistance levels. Right now, we're coming up on resistance. I'm going to move this line. I'm going to zero in here. I'm going to use this line. I had it here before. That was where that last, I had called for a pullback there a couple days ago at that level, but we went a hair above it. So now that's your previous reaction high. Traders look at that. Most likely to get a pullback here. Okay, so that's it. Resistance 1. The other day when we were coming off this divergent low, I gave you, it was, I think, here to here. Again, I had it hand drawn in on my screen capture software, a bounce target zone. And that's why we hit the bottom of it. And then I also recognized the downtrend line. That's why I figured we'd get a pullback. We did. So these are your levels now. And again, let's see how the market, I'm not an expert on these tariffs and how it's going to play out. I'm sure there's a lot of people, above my pay grade, institutional traders that have a plan for whichever way it went. Right now they're buying it. But again, I think there's going to be a lot of uncertainty. Let's talk Treasuries, because that's what I heard is going to be the potentially the biggest issue again if the folks on CNBC are correct. So unless you're brand new to the site, my views on Treasury bonds and interest rates, and maintained, this is something that's out of the textbooks. They're going to have to change the textbooks if this doesn't hold true. There's one immutable fact in investing in the stock markets, and again, taken over a long period of time, and that is falling interest rates are bullish for the stock market and the economy for two reasons. Number one, it lowers the cost of capital. When the cost of capital is lower, you can go start a business. A company can open a new plant, expand production. And again, a lot of investment occurs. Rising rates has the opposite effect, of course, right? And again, that goes to homeowners as well. You can get a 3% mortgage. You can buy, same thing with consumers. You can buy, a bigger house or a second house, and car, second car, boat, plane, whatever you want to buy. When capital is cheap enough, and when cost goes up, your cost of a mortgage, a house, a car, all that goes up, and slows things down. And it's the farthest thing in the world, in my opinion, from mere coincidence that this is the strongest bull market in history, coinciding with the biggest bear market. This is a 40-something year. This goes back to right around the beginning of the 80s. So we're talking, what is that, 45-year, almost half-century trend of falling interest rates, and they were in a very clear channel. I've maintained many times since that this was the end of a secular bear market. Remember, you have secular or your larger trends, and cyclical, we have cyclical bull and bear markets within there. Those are the ups and downs within the channel. And each of these, this is where the Fed started getting cute with quantitative easing and zero interest rate policies. They figured every time the market hiccuped, they could do it. And then they figured, you know what? Everybody thought we'd get inflation the first couple of times we did quantitative easing and zero rate policies. So let's F it. Let's just go all in. And that's what they did when COVID hit. They just went all in, hit the nuclear button, and that ended it. So by every single metric, uh, meaning higher highs, higher lows, the primary downtrend line being broken. Every single technical metric that I use, and they're pretty simple, that was the end of a downtrend. We've begun a new secular bull market in interest rates. I don't hear anybody. I'm sure others may have that belief, and maybe I'm wrong. Maybe we do this. Nothing's guaranteed. Nothing's written in stone, but I feel strong on that. It's from my read on the charts, and so where I'm going with that is if I'm right, and these things take time too. We've had some, couple healthy corrections along the way, and rates pretty much back returned to normal. And that's one reason you see such a big move up. This was extreme low. This was near zero rates. Even this is the 30-year bond, by the way. We were under 1%. There's a 1% mark right there. So that's how low they got. Obviously, short-term rates were at zero. So what it did, it took us back. The reason this didn't just wreck the economy is there are two reasons. Number one, and this is well documented. This is not my opinion. This is fact. Both individuals and corporations took advantage. And no offense, please, if you were in the situation to do so at the time, you didn't, but only a fool didn't refinance their house, or only a foolish business didn't refinance their debt. And most businesses took it a step further and even took debt out. Apple's a great example. They didn't need to borrow money, and they started selling bonds throughout this in order to buy their stock back, only because it was free money. And so the reason this didn't wreck the economy is that so many, just about every institution and individual that could, refinanced here. And you refinance not for a week or a month. Average business loans, short-term, small caps tend to be about 4 to 7 years, I think it is. Large caps a little longer. So they've locked in. And so that's why this hasn't, derailed the economy yet. But they are starting to come due now. That was 2020. Rates started to go up. And so going forward, and this is what I'm watching right now, is if we break out, as I've covered many times, and by the way, this is that white line above is the S&P 500. So again, this is when rates were high, and we had a series of bear markets in the 60s, 70s, and rolling recessions, and the stock market went nowhere for a decade or more, with a lot of big bear markets in there. It doesn't look like a lot because I use log scaling. And so as I've covered many times, again, this is the supercharged bull market, supersized market we've been in. And let me do this. Let me turn off the S&P comparison and just focus on bonds. Okay, so we're going to drop down. Let's drop it down to a weekly chart. No, sorry, I have to go back to a monthly. Okay, so this whole thing right here, I have it circled, a circle tool, but there's a box too. This isn't mere coincidence to me. The stock market has been grinding around, right? As I've showed you for many, many months now. The S&P and the NASDAQ, right? Going nowhere in the same range, similar, comparable range. And my expectation is that the stock market will probably ultimately break to the downside. Now, it can go either way. If that happens, it will likely, there's a good chance it'll occur. And this scenario only goes one way. If Treasuries break out, we had a double top high. This is a 30-year bond. The 10 looks similar. Again, I've covered this. It's going to take us back. As I take this line here, I'm keeping it horizontal, and I'm moving to the left right here. That takes us back to where rates were in the late 90s. Throughout the late 90s into the early 2000s, you're going to break out. That means interest rates will break out to multi-year highs, multi-decade highs, I'm sorry. And I will eat my shoe if the stock market doesn't take it on the chin. Now, that hasn't happened. That may not happen. But I can only see the only way. There's no possible iteration, variation, permutation of a scenario where that's going to be somehow bullish for the stock market, where the stock market won't go down. This way, if we break to the downside, it can be one of two things. It can be organic, a natural abatement in rates falling, or a flight to safety bid. So you could still have the stock market going down there, or you could have the stock market going up. So that whole trading range in the stock market, the S&P, if it does break out and we have a nice 2026 and beyond, and the Nasdaq 100 breaks out and the Mag 7, 8 come back in favor, and we're going to see another 20% gain this year and over the next year or so in the stock market, um, it's almost certainly going to have to entail this range with Treasury bonds going down. So that can be bullish, but this can also be bearish if it's a flight to safety. If the market crashes for any of the various reasons out there, um, you would see institutions you could very well see do a flight to safety bid. So watch this. And look, just like as I said a minute ago with the stock market, especially the NASDAQ 100s at this point, at greater risk of breaking below the trading range because it's in closer proximity to the bottom than breaking out. Same thing with Treasury bonds. Right now, they're closer to the top of the range. So watch the 10 and the 30. I'm just holding on the 30-year here. This is where I showed you how the Fed lost control of the yield curve, cutting rates, 3 rate cuts, saw nothing but rates go up. Then they waited a year. They did a trio of 3 back-to-back rate cuts again. Same thing happened. So it's clear that the Fed has lost control of the rate curve. I'm talking about this again today because what I've heard, again, unless it's not accurate, if it was bad reporting, that the Treasury is, now the U.S. has to pay back billions in tariffs, and they just can't, afford it. So how are they going to do that without issuing, debt? And so that's where I think the risk on Treasury bonds now, unless there's something I'm not aware of, and again, I'm not an expert in these treasuries, I think that's to the upside. You also have, as I just circled here, you have a downtrend line, you had a breakout and a back test right there. So keep an eye on treasuries. All right. Okay, last but not least, because I don't want it to be too long-winded, I just kind of want to speak to the equity markets. I already gave you updates yesterday on the grains. I still like wheat, things like that. BIZD, the business, that's the main BDC income ETF. Those are business development companies, aka private credit. Back here, before I heard a single peep about it in the media, before most even knew what they were, I started zeroing in on this, saying I think this could be the potential for the next shoe to drop in the market. If 1574 support broke, we were going to drop. We did. I give you 4 price targets once it happened. We hit the 4th and final target there, and then we turned around, covered that short, went long. I gave you 1, 2, 3 targets, even though I removed T3 when T2 was hit. And I did that right here, rightfully so, because I expected, just like I pulled the plug on the Treasury trade the other day at the right time, did the same thing with natural gas. If you remember 2 weeks earlier, canceled my next target because I thought a big enough pullback was likely off the current target. And that happened here. So we sidestepped it. Would have stopped out just about anybody because it would have took you back to entry. It did end up going up there. And again, I stayed away from it at that point. And once we hit T3, then I threw it out there as an objective short again. And so we've gone down. Here we are. We keep making, we went long here because we had positive divergence. We have positive divergence here again. This 12.97, let's call it $13. That's a critical support level. That's when the bottom was falling out of the markets in 2020, that was the reaction low. So the latest headlines, if you read, keep up on the financial news, Blue Owl halted redemptions. And what they did is, this is one of the biggest private credit companies. They and I read the article, and my God, if the way they spin things. Whoever was commenting in the article, they interviewed somebody that said they were able to unload a fair amount, I forget how many hundreds of millions of dollars of some of their loans at 97.5. That's what that means in credit world and bond worlds. Par is 100. Mean face value, dollar for dollar. If you have a bond, it's and then distressed credit will sell it. If it's selling at 70 cents on the dollar, then that's pretty bad. And they cheered that, and they said, "Oh, that's a very good sign." They offloaded that stuff to pension funds and some other institutional traders. Well, first of all, pardon my French, but no shit. What are they gonna try to sell you when you have to sell? They had to sell. They had to close the door on redemptions, which is a very bad sign for the sector. It's going to has a potential to cascade a lot of the other private credit companies from starting to get redemptions. The way these things work is just like hedge funds. A lot of them you can only take your money out every quarter, sometimes every 6 months, sometimes even once a year. They have windows, and then and they have the ability, the managers, to limit or even completely close those windows. And so what it can lead to, this may be the shot across the bow. I mean, if the other two bankruptcies earlier, First Color and Tricolor and First Brands, those two bankruptcies that started rocking the sector, long after we were shorting it, long after, it was predicted something was going on there. So this has a potential to now have a cascading effect where other individuals are going to say, you know what, that's Blue Owl, but who's next? So I'm going to start taking money out. When they take money out, that's a bad thing. And going back to what I said about, no shit. Of course, they're going to sell the most liquid paper for two reasons. Number one, even if they wanted to offload, something, some troubled loans, and they do so at 70, 80 cents, 60 cents on the dollar, that would have caused a much bigger panic. So they had no choice but to sell their most liquid prime paper, right? That only makes sense because of the optics of it. And so they could say, oh, and Cheerdo, yeah, we found it's a liquid market. We were able to unload this amount. The fact they had to do that and, of course, sell off their best quality, some of their best quality loans tells you something, right? Now they're, what else are they holding? They've shut the doors now for redemptions, and you can only imagine most of the other stuff they hold is of questionable quality. So I would just want to point that out. And again, it's all about the charts. Again, we can sit here and all day long. All I can tell you is that BIZD. Let me type it in again. BIZ. No, I'm a bad typist. To look at my keyboard. That's it. So look at that. There's that previous low. We had divergence. We had a bear market rally. We gained it. And now we have divergence again. And so I think we're at a make or break it level, guys. I think from experience, when things start to crater, that whole, Jamie Dimon, when you see one or two cockroaches, there's usually more. I know that to be true. And I remember similar things happening in late 2007, early 2008, before the bottom fell out of the market. And I keep seeing mounting evidence ever since this sell signal triggered here. You can go back into, late last, year when we started covering this and multiple updates. And here we are. This sector keeps going lower. You have the S&P 500 in spitting distance if it's not at a new all-time high today. Why is private credit down here? And this is, again, it's not as big as the public debt markets, meaning corporate debt and government debt, but it has the potential. One little subsector of the financial market can have ripple effects that trigger throughout the financial sector. So that's it. And look, I can tell you right now, I can make a case. You're at support, positive divergence. You can go long here. I'm not. I would rather be the second mouse this time around that gets the cheese and not go home into the weekend in case there's some credit event that comes out, another bankruptcy, another private credit company that closes the doors. I would rather see us, start to stabilize and move off. And if the stock market holds up next week, and whether or not we, attack Iran or don't attack, whether that cools down or heats up over there, I just think the risk is too big, because sometimes these best looking setups like this, you can just gap way down below it. So again, it's risk reward. I evaluate every trade I go into on a risk reward basis. I would rather miss an optimal entry, which is right now at support. And remember, there's no buy signals. Then again, there weren't either here when we hit T4. We covered because it was my final target. And then I turned around and put it as a long trade because we were at support. It was this reaction low back there. And we did bounce as expected. But I keep seeing more and more bad news developing in this sector. And again, as I said, I think the market is mispricing risk right now. I think it's mispricing risk with what just happened with the tariffs and what it may do to the Treasury and our federal deficit. I think it's mispricing credit spreads, and I think it's shrugging off or dismissing this as a kind of a one-off sector when, again, it can spill over to other areas, including but not limiting, limited to specialty financing. I already covered the broker dealers, and let's remember XLF too, the main, the financial sector, which has the banks, insurance companies, everything. As I said, this one's playing out exactly as I've been expecting. Failed breakout to new highs, bear flag pattern, breakdown played out, break and back test of the primary trend line. Then we broke my 53.10 support. Then we took out the 200s, check. We hit the 51.08. We bounced back to the 200s. It's so far rejected. And my final check mark comes if and when 51's taken out. And that will be, in my opinion, an all-in moment short for the markets because especially, let me just caveat it, put a little asterisk there. Give me my line tool. Somehow if the Mag 7 really can start firming up and take back the baton, but they have a lot of work to do. And I've had nothing but multiple sell signals on those lately. So I've stopped covering those because I've already checked off a lot of check marks there. This is the last shoe I've been waiting to drop. And this is related to, private credit. It's financial sector. So, all right, guys, that's it in a nutshell. I know it's kind of all over the place, but in my head, it's not. It's all very, very much related. The stock market, the bond market, which is part of the, Treasury market, which is part of the credit markets, and then the private credit, corporates as well. I'll be watching that, junk bonds, and of course the financials and all these subsectors within the financial, including and not limited to the broker dealers that I just did a extensive video on. So that's it, guys. I think this breakout right now in QQQ is a sucker's rally that will get faded into the close when individuals and institutions alike realize the going home long over the weekend might entail more risk than warrants, and I think this breakout's going to fail. And then to leave it here, and one last thing, remember, if I'm right and this breakout fails today, clearly, meaning we clearly fall back below and close below the uptrend line, downtrend line, as I often say, fewer things in trading are more bearish than a failed breakout. Why? Because everybody buys it, the longs go in, and when it fails, they realize they're wrong. And their stops should be, if they're trading, with discipline, they should have stop loss orders below there. And those stop loss orders are sell orders, and they accelerate selling. And then the sharks like me, flexible traders that are just as comfortable shorting as going long, smell blood in the water, and they jump in. And then boom. And that could be that hammer down next week. If we sell into the close and that breakout fails, I think this market could close down 2-3% today, even though we're up right now almost 1% on the NASDAQ. All right, I'm going to wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.